Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and I trust you're looking forward to the weekend. It's a little bit of a lackluster day, although there is a little bit of a Fed president debate happening at one of the universities in the United States during US time, of course, and that could provoke a little bit of volatility. We're also getting the University of Michigan's consumer sentiment survey, and that's always one to be closely watched. There should be some improvement there, but just do keep in mind we're still at crisis GFC recessionary levels, even with a significant bounce on that number. But the market is likely to overreact to such an event. Should it, however, fall, that would be what the heck is going on? But it's more likely to stabilize to rise, and the market is likely to overreact to that news. Also, a meeting between Biden and McCarthy has been delayed. People are saying from Friday, it's been delayed. People are saying that's because there's been some progress in mid-level discussions. That remains to be seen, but certainly that could support equities on the day. And remember, a default isn't really priced into equities. That's why, or the US dollar, which is why they're vulnerable should the event occur, which I'm only giving a 25% probability to, but of course that's way too high. But do take note that the market could be buoyed by good news on these type of things. Also, as I've been suggesting last few days, I do see geopolitical tensions generally beginning to moderate, and that is going to be good for markets as well. Nevertheless, equities are largely sideways, as they have been for many months now, but with fits and starts that really have no historic precedent. So what is really going on? Well, nobody really knows. But what I do think is happening is the US economy is settling into severe below potential performance. And that will be more in the 0 to 2% range, maybe the -1 to +1.5% range over the rest of this year. It would really surprise me to do much better than 2.5% for US GDP in any quarter this year. It does look particularly lackluster. The banking crisis, as my good friend, no, he's not really, but we have appeared in the same articles together, Jamie Dimon, he is suggesting that it's about time we get this banking crisis behind us because it is ongoing. And he said, there should be further regulation. Well, of course, he likes that because his bank is sitting at the top of the pile, benefiting from all the regulatory errors the current administration makes or regulators make. So I think what was interesting about that is that you have Jamie Dimon admitting or, really endorsing that there is an ongoing significant banking crisis in the United States that does need to be addressed. And as I've said, despite bond yields dropping a bit overnight, I do think bond yields have very little downside, and I do think you need to be selling bonds after this rally completes itself for yet higher yields, as there is a general disinvest from the US feeling about things going forward, simply because the rest of the world has caught up to the US, and many parts of the world have passed the US clearly in all sorts of criteria. So a more diversified world, and again, I'll emphasize it, and I'm sorry if I say it too much, but the slowdown this year, despite China's lockdown period, has largely been driven by the Western economies, as it was last year, and I do see that being a prevailing trend going forward. I see US economic underperformance being a prevailing trend going forward. I see core inflation continuing to persist at way too high levels, which will keep the Federal Reserve at best on hold and still does risk the Fed raising interest rates in 2 to 3 meetings, maybe 4 or 5 meetings from now after an extended hold period. And that, of course, goes against absolutely everything you're reading and hearing elsewhere. And that's the way we like it, because the biggest opportunities in markets are when the market has it wrong. You don't make a lot of big money when market sentiment is correct. You make your biggest money when market sentiment has it wrong. So that's something to sort of put in your back pocket and be mindful of that potential trading opportunity there, should I be correct in suggesting, well, I've been correct in suggesting there'd be no pivot yesterday. Interest rates were supposed to have already been slashed 100, 200 points by the futures pricing at the start of the year. So this is not going to happen. So I've got that right, but I'm still pitching out there, swinging for the fence, they call it, that there could be yet, I think we're going to get at least an elongated pause from the Fed, and further rate hikes are not out of the question. So do keep that in mind. US dollar seems to be settling into a sideways consolidation pattern. Perhaps we are entering a period where markets go a bit quiet. Where all the excitement, the fear, euphoria, both things are beginning to diminish, and we get a consolidation period for markets moving sideways, which would reflect probably the lackluster fundamental economic backdrop. I still like oil higher. I still like gold higher. Hope you have a good weekend and the week goes well for you next week, and may markets be fair, maybe even be kind to you. Have a great weekend.